Liu Li-Gang is head of Greater China Economics Research at ANZ Banking Group. Li-Gang, thanks for joining us. Okay, 51, so it's slightly to the upside here, but it does show that, well, there is no slowdown.
That's right. This shows that Chinese manufacturing activity have had a sustained recovery. Going forward, it will really add to the risk-on mode to the global markets.
All right, well, you know, the thing is, what are the dangers for this actually falling back?
Yeah, going forward, we think inflation may be a potential risk again for the Chinese economy, largely because oil prices have surged quite a lot. We have seen copper prices and other commodity prices are coming back. Going forward, with the pass-through effect, inflation will be a risk for the Chinese
So have you
economy.
been upping your forecast for inflation looking ahead
At this
now?
moment, in fact, our inflation forecast is above the market average. We still see a 4% inflation for the coming year.
Well, people were talking about probably 3% inflation. We're looking May, June. Is that going out the window now?
Well, I think perhaps going forward we will see a slight rebound of the inflation. Probably May, June we could still see something around 4 to 5% in China's CPI inflation.
Central bank's not going to be that happy with that. So I guess this loosening policy that we've had of late, is that now, well, on hold?
Well, if we have a rising inflation risk and also trade surplus remain large, the chances for further reserve requirement ratio cut will be limited. Also, we have to keep in mind that the PBOC has many tools at hand. If they stop sterilize capital inflow, for example, with substantial capital inflow, they don't have to ease as much as market is expecting.
Yeah, because the liquidity enters the system naturally that way, doesn't it? Okay, I just want to find out one other thing. The transmission method for a high oil price into the CPI. Now, it's not as easy as all that, is it? Because a lot of the distilled fuels are actually heavily regulated.
Sure, and we have looked into this recently. We found that whenever you have a $10 price increase in oil, and Chinese PPI inflation tend to be affected by 0.1%.
Is that all?
At this moment, yeah. But if we have a $50 increase in oil price, the transmission tend to be larger. Keep in mind that at this stage, more than 50% of Chinese oil are from imports. So we will see stronger transmission from oil price to Chinese PPI and the CPI going forward.
Okay, but we look also at the weakening picture for exports, particularly with China's biggest trading partner, when I'm talking about Europe here. That's affecting things quite badly.
Yes, but recently, we look at the Shanghai Container Index. We found that shipment to Europe has started to rebound. We expect that February Chinese export growth will have a strong rebound. We are thinking over 30% or 40% increase could be a possibility.
So a bit of confidence here then?
Yeah, definitely. And that's why, as you mentioned, I think going forward, inflation could be a bigger risk than the European slowdown.
All right. Is housing still the biggest unknown in China?
Well, this is still a weakest link in the Chinese economy for sure, and as housing affects many upstream, midstream, and downstream industry, affecting local government financial conditions and also the banking sector health. If there are some fine-tuning policy, and we think that we will not see a slump in Chinese property market.
Liu Li-Gang, thank you so much for joining us there from ANZ Banking Group.